Megan, Bloomberg Intelligence sort of crunched the numbers and saw how much GDP would be reduced, how much equities would be reduced on a U.S.-China trade war, on a U.S.-Mexico trade war, and the overall equity market. The yellow bars, U.S.-China tariffs, the orange bars, U.S.-Mexico tariffs, and then the 10% fall in equities. It feels like the trough is the third quarter of 2021. What do you see?
So I think that these models don't have a line for tariffs. And so in order to actually model out the implications on GDP, you have to lean on a whole bunch of things like currencies. You've got to make a whole bunch of assumptions. These models don't know how to deal with successive shocks like we're seeing with this trade war. And so I would, for the most part, take these models and sort of throw them out. What we do know is it can't be good economically for the U.S. economy or for global growth, but the size of the impact is really hard to actually measure.
Not good for the U.S. economy, also not good for the U.S. consumer. I mean, Alex pointed out a terrific Bloomberg News piece that basically said already what the president's done is taken most of the benefits of the tax cut.
That wasn't me, that was Kaylee.
Okay, Kaylee.
I was Kaylee in the control room. I'm going to give Kaylee credit where it's due.
But it's a fascinating study that suggests that already, with what's been imposed already, before you get to Mexico, before you get to increase China, you've already given back almost all of the benefits. If you go forward, then the typical U.S. household is going to be in the hole.
Yeah, I think that's right. Now, the question is how much are businesses really going to pass this on to the consumer? And, you know, with further tariffs with China, consumer goods will be hit much more directly. But generally, talking to businesses and talking to Fed governors who spend all their time talking to businesses, the story is that businesses are seeing margin compression, largely because of higher input costs. It's partly a piece of the tariff story, but it just isn't bad enough for them to go ahead and pass the cost on to the end user. So there's a little bit of an increase in prices.
That's good news for the consumer.
That's right.
Not so good news for margins and for corporations, for shareholders.
Of course. So there's margin compression, absolutely. But I think in a world in which everybody's trying to compete with Amazon, nobody wants to hike their prices and lose market share. And so I think that's a real issue for businesses. But for consumers, in terms of inflation, I don't think we'll see a massive increase in inflation off the back of these tariffs, just because businesses will continue to go with forbearance.
Well, in that great article, if you look at, say, different calculations, like from the Peterson Institute, if you do like full-blown tariffs on Chinese goods and then 25% by October on Mexican goods, it's kind of like over $3,000 hit on the U.S. consumer. What's like the tipping point where the consumer falls out of bed and that really then has repercussions for growth, for a recession?
So that's a great question. The Fed did a study that showed that I think about 60% of U.S. households can't handle a $400 emergency charge. And so if you consider that the tariffs that we've already imposed on China actually increase the cost for an average consumer by over $400, I think that's already going to drag in the consumer. And of course, the consumer accounts for about 70% of U.S. GDP, or consumption does at least. And so I do think that this will be a drag on growth, but I don't think it will hit on the inflation side as much.